Jeremy, welcome to Abu Dhabi Finance Week and our event on site. It's so great to have you here. Thanks again for joining in.
Great to be here. Thank you.
So let's talk about what we're seeing right now in this space, because you have argued that stablecoins will ultimately become the core plumbing of global finance. I want your take on this. How close are we to that reality today?
Yeah, the framing I like to use is, as an infrastructure, we think about technology infrastructures or internet infrastructures, these phases we've gone through. We all remember the phase of the web coming, and then broadband, and then mobile platforms and cloud platforms. And now we really have two new major technology platform paradigms. One, which is AI platforms, which I think broadly we can all agree are not just an actual new infrastructure, energy, compute, inference, et cetera, but are actually almost like operating systems. They do work for us, they automate, they conduct tasks. And so we have this sort of automation operating systems, this very, very different set of infrastructure, which is itself going through an inflection point after about 15 years of really exploring. The other is these blockchain networks, which similarly actually have been around for about 15 years and have recently gone through some major maturation. And when we look at this technology, we look at these two key pivotal infrastructures, AI infrastructure and blockchain infrastructure, as in some ways two sides of the same coin, no pun intended. Blockchain networks really represent the economic operating systems that we're going to build future economic infrastructure on top of. And so if in some ways AI is, these AI platforms are kind of the nervous system, the information going about, the circulation of value is going to happen on these blockchain networks. So we're hitting an inflection point in technology maturity. And we'll come back to it. It actually, this infrastructure increasingly is going to be infrastructure that is back to back with compute clusters, inference clusters, AI agents, and other things. But we'll maybe come back to that in the conversation. But I think at a practical level, in a world where more and more of our economic activity is going to be conducted between AI and AI agents on the internet, and where we haven't had an infrastructure that is built for the internet for economic coordination, that is where we're seeing this come in. And now, if we look at the numbers, which gets back to your question, it has arrived. I mean, just take for example, our stablecoin network in Q3 handled $10 trillion of transaction volume. And that's up 580% year over year. And if you look at what's happening with stablecoin money, these digital dollars, it's just growing around the world. And so we now have this programmable financial infrastructure, which never existed before, and people are really leaning in.
What's also quite interesting to me is that through the most recent crypto rout that we've seen over the last couple of weeks, there was money moving out of Bitcoin, but actually flowing into stablecoins, which tells me that money is staying inside the system despite that recent bout of volatility. Question for you though, Jeremy, on this, because of course, one of the key trades that we've been watching through the course of this year is investors staying long USD. Does USDC ultimately strengthen or weaken the US dollar as the world's reserve currency?
Well, I think there's sort of a couple questions here. I think one is, what are going to be the primary digital currencies used on the internet? If we're going to have internet native digital currency, which we do now, what are going to be the primary currencies? If we look at the world today, and energy is a great example of that, energy transactions, energy and commodity sales, overwhelmingly financed, traded, and sold in dollars. And there's some hemming and hawing about that. And, there have been sanctions issues that have caused people to worry about that. There's debt issues people worry about. Those are all real. But at the end of the day, the network effects and the liquidity that exist for the dollar are very strong. And I think when you think about an upgraded digital dollar, if you think about a technological upgrade to the dollar, well-structured, regulated stablecoins like USDC will strengthen the dollar. They will provide more competitiveness for it, more utility for it, more global reach. And in turn, what is the dollar other than the underlying debt instruments of the US government? And the legal and regulatory structure of stablecoins under US federal law, the Genius Act, which was passed this summer, really requires that we are holding these US Treasury bills. And so not only does it extend the utility of the dollar around the world, it also creates demand for the US sovereign debt. And so that strengthens the dollar because in a sense, those are, again, two sides of the same coin.
I've got some very basic questions for you, but I'll just follow up first of all on the point you were just making there as well. And Dan talking about the crypto drawdown, the concerns there as well. It's adding a lot of volatility into crypto, even into USDC. It's adding volatility into the AI use case in many cases as well. Does that have ramifications for the investment scenario? It's not going to be linear, the investment as well. We know that it's going to be lumpy. But do you think that when you see major events, as we've seen from the October highs of crypto to now, and the follow-through effects, that's going to have ramifications on risk appetite and therefore the amount of money that gets invested?
Well, I think there's a couple things. If people are speculating on an asset because they think it's something like gold, and then there's a macro shift where the risk profile shifts and the investment profile away from a hedging asset happens, that's normal course, right? That just happens. And I think what we've historically seen is assets like Bitcoin, trade in line with other risk assets broadly. And obviously the AI Mag 7 phenomenon has changed some of that because that's its own behavioral dynamic in a sense, as opposed to sort of broad-based technology risk. But also the magnitude of volatility has tended to be a multiple, sometimes twice the volatility, but the volatility has come down overall, but twice the volatility. But I think you have to separate out, there's technology infrastructure that is all of these economic operating systems, these blockchain networks, all the software infrastructure, all of the financial intermediaries, products and services globally that are being built up around this. You have to really separate that out from people who are focused narrowly on digital commodity trading and speculation, because they're fundamentally different in their behavior.
Okay, before I go on, by the way, I've just remembered, you guys want to play on this one as well. You've got your old friend Slido to get involved in as well. So Slido, to get your questions in. There's two of us now, so you probably won't get a word in edgeways, but we'll try and get one or two in near the end of this as well, before we get to His Excellency and the next panel. But no, you mentioned gold there. I'm going to challenge you on this one, Jeremy, because nobody says to me that gold is the tail wagging the dog of the global markets of investments. And one thing I have noticed, that Bitcoin and crypto and investments in stablecoin, it does seem to be that it is a leading indicator on risk appetite as of late. Now, I wonder if you'll challenge that as well. But when I see that dictating whether people are more excited about or not in investing in AI or AI infrastructure, both in the private or public markets, then I start questioning its role.
Yeah, I mean, look, you have to look again, just take the internet as a technology, okay? When billions and billions of dollars went into building the initial infrastructure for dialing up to the internet and building websites and building online services, the dot-com boom, we all remember it extremely well. All of that was, all of these are valid investments. It's that the infrastructure readiness wasn't there and the capital overreached the readiness. That's the debate we're having about the AI bubble now. Is that going to be the case there? Successive waves, which would say the broadband CapEx wave and the mobile, fixed wireless and wireless CapEx wave, and the coming online of the new software utilities that made possible, is another big CapEx wave that then brought on top of it a huge value of software development that then unlocked, again, user utility and so forth. blockchain network expansion is no different. We're seeing capital formation in tens of thousands of companies around the world. We're seeing major companies investing in the infrastructure. I'm not talking about speculating on assets.
Yeah.
I'm talking about actually building the infrastructure. And that's what people should be paying attention to. Where are we? Are we about to have an iPhone moment? Are we about to have a Netscape moment? These moments in time?
Or Jeremy, are we about to have a Cisco moment? And look, I've followed you, and I agree
Sure.
with you. We're talking about the real capital rather than the speculative.
But what I can tell you is,
and it took 20 odd years for Cisco to get back to where it is now.
What I can tell you is that the number of major institutions, major financial institutions, the world's leading financial institutions, the world's leading asset managers, the world's leading payment companies, the most important systemic financial market utilities in the world, every single one of these is leaning into building in this infrastructure right now. And that has nothing to do with the price of Bitcoin. That has to do with an upgrade to economic operating systems that run infrastructure to facilitate a better financial system that is built up on this technology. They're very separated. They're correlated in people's minds, but these are very, very separated infrastructures. And again, I do want to come back to the connection between AI and crypto as well, which is a huge connection and ties back to the financing of energy as well.
Well, let's talk about that. And also, I think also thinking about the impact on energy here, particularly when it comes to commodity trading. Today, commodity trading, really linked to these legacy payment rails, antiquated infrastructure. It's slow, still using the USD. What happens to global commodity trading, particularly around oil, for example, when we see a tokenized dollar being able to settle 24/7 in real time?
It's a huge opportunity for the entire energy industry. And I'll tell you a couple stories that bring this to life. The price discovery on energy and on commodities like oil, et cetera, the price discovery of that is executed in futures markets. And the biggest futures markets in the world are, some of these platforms like the CME and many other derivatives exchanges around the world. And the heaviest users of those platforms are these big markets and trading firms who provide the liquidity to provide the price discovery that ultimately allow for the best contracts to be made available to people. So that infrastructure, as you said, still requires, in some days, multiple days to get collateral in place, to actually get settlement done, et cetera. Now, these exact same firms who are at the core of energy's futures trading are also the very largest firms trading crypto. They're literally the same firms, the systemic electronic markets firms and trading firms. And what's interesting is that all of those firms use stablecoins like USDC. And all of those firms have now execute trading strategies on markets like Binance, which is here now in ADGM, derivatives markets that are 24/7, 365 with the ability to do real-time positioning of collateral, real-time margin, real-time settlement, and they run constantly. And so all of these big firms that are at the core of the way these, in some ways, more advanced markets now work are basically coming to us, and they're coming to the big derivatives exchanges and the platforms that actually provide the infrastructure for price discovery on commodities and saying, why can't we do this over here? Why can't we have these dramatically more efficient, not just markets, but also kind of fundamental settlement? And in fact, just in the past couple of weeks, we've seen the Commodities Futures Trade Commission interim chair, Carolyn Pham, rolling out concrete proposals that are going to be embedded in rulemaking that will allow us to upgrade our futures markets and effectively the fundamentals of price discovery on energy futures using stablecoins as a settlement asset, as a collateral asset, et cetera. And so these are coming together. And it's all about capital efficiency, speed, time to settlement, which in these markets, as you know, is very, very vital.
Yeah, absolutely. And this is so interesting. So just with regards to the timeline on this, do you expect the major commodities, oil, LNG, hydrogen, even carbon trading to be eventually settled on chain? And if so, when?
I mean, inevitably, every single one of these will be settled on chain, and they'll be settled on chain using stablecoins. They'll be settled on chain using tokenized deposits, which is another tokenized money form. And the medium of exchange, again, what I call these economic operating systems, can actually codify in code the contracts themselves, the delivery side of the contracts, the accounting side of the contracts, all of the proof points along the way for what takes place in the market. It's not just move value from point A to point B. It's the totality of the economic contract that will become automatable in very different ways and running on these networks. And so as that happens, the native money will also need to be there. And so what's happening around the world is, UAE is a great example of that. The UAE has been, really at the forefront of enshrining in law support for stablecoins. There's now a robust stablecoin regime here. And, obviously in the US, Europe, and other markets. And what that, I think, will translate to is that the CFOs, the treasurers, the guys and gals that are actually buying and selling and who are in the core of this are going to effectively be able to treat this as an equivalent infrastructure to the legacy international banking rails as well. And that's on the horizon as we speak. And now some of that's happening ad hoc today, but on a broader basis, I think that will play out more substantively over the next couple of years.
Just want to say thank you to all our audience who are putting questions in. We'll come to those in a few moments' time. By the way, Anchor, wherever you are, you're fast becoming my favorite audience member. You're keeping me going. Thank you. But I want to ask you some really basic questions. I'm going to go way back down. This is my one. Do you know your energy usage?
Excuse me?
Do you know your energy usage at work?
I do not.
Isn't that extraordinary? I mean, we're talking about the marriage here of AI and stablecoin and technology and the energy usage. And there's so many of us. I couldn't tell you what my energy usage is as well. Do you know what percentage? And again, I'm not trying. It's not a gotcha. I genuinely, what percentage of your energy usage is coming from renewables?
I do not know the answer to that.
And again, I don't either.
Yeah.
I don't know. And actually, let me ask you. I'm going to ask you to put your hands up. And this is an honest question. I'm mea culpa. I have not got a clue. How many of you know? Put your hand up if you know what percentage of your energy usage comes from clean tech or renewables. Of course, the lady from the Nuclear Association. I would have known that. Does anybody else? 2 people. So I think, let's say there's 3 people. There's probably 200, 150, 200 people in this room. And we're talking about 1.5% of us actually know. There's an action point, ladies and gentlemen. Let's all go away. And in the next couple of hours, and I'll test you all. You can all email me. but we should know. We should be doing that. Do you think that the industry as a whole, Jeremy, should be working harder on that? And again, this is having to go at myself. I do not know what percentage of my energy usage is clean tech.
I think everyone should know, and I think our assurance firms and our audit firms and then sort of our vendors should all help us with that. And obviously, there have been proposals on kind of accounting methods on this that have not been consistently rolled out, but it is something that I believe everyone should work to understand.
Because I mean, one thing I'm sure you do know, your utility costs must, as you've expanded and become ubiquitous, and stablecoin is just USDC, brilliant growth. The energy usage must have gone up not exponentially, but quite significantly.
Yeah, I think for us in particular, say Circle as a whole, we don't have a lot of footprint. We've got about 1,100 employees with laptops, and we use the cloud for our software. Right. So for us, we're like we don't got we're not making cement and all that stuff. But the blockchain networks sit in data centers and validate transactions, and those are used. And we actually can estimate basically the consumption of blockchain infrastructure that we
and what do you observe?
that we use. I mean, we can estimate it. I don't have that number in front of you, but I think we're we're a significant volume of transactions on some of these networks. And each of those do, in fact, some of those networks do publish their own kind of energy footprint as well. So we could, by proxy, get our way there. And it's a great thing, and I'm going to make sure my team I
think
that.
and the growth in the accelerated servers part of data centers is somewhere in the region of like 30% a year. So we're talking enormous numbers here. So sorry, I've given you all homework, and I certainly wasn't trying to pick on Jeremy. I'm picking on all of us, including myself. Let's all go and find out how much of our energy is coming from clean tech. Daniel, you're going to get it back on track.
Well, to Steve's point, and as an extension of that as well, Jeremy, do you think that the energy intensity of the industry is going to be a barrier for future development?
So there's mythology here, right? The overwhelming majority of activity on blockchain networks is not energy intensive. Bitcoin itself, which is a very small percentage of the transactional activity in this whole industry, is still a proof of work mining based, energy intensive based system. But basically all other networks that, and in fact, every network that Circle's infrastructure runs on, use something called proof of stake, where they're dramatically lower energy footprint. And that was a very explicit change that was made where networks saw that they could use people staking value and putting kind of value at risk to provide security models for these decentralized networks. And that model has really taken off. And so the footprint there is absolutely significantly lower, and I would argue lower than even your typical kind of cloud compute type of infrastructure as well. So it isn't for stablecoin networks and sort of broader tokenization and so on. It is not, it is not an impediment, right? It sort of generally behaves like people who are, maybe there's more websites being built on Amazon or Azure or Google Cloud. There's more blockchain apps, similar type of I think inputs, so to speak, into the infrastructure side.
Jeremy, I think again, I'm here to ask all the obvious questions as well. But you mentioned about the regulations and the rollback. Is it as you expected it would be under this administration in the United States as well? One reason cited why crypto has come off is that people were actually underwhelmed by the emphasis and the impetus that the administration is putting behind blockchain and crypto as well. Have things panned out this year as you expected? And if not, where do you hope to see greater impetus?
Well, a couple things. I mean, it's been extraordinary. We've seen the first major piece of financial regulation passed in the United States in decades. The Genius Act was an act that really got its footing as a major Democratic initiative, and then the job got done on a bipartisan basis between Republicans and Democrats. A very bipartisan bill. Super majority in the Senate, a huge majority in the House, something that leading Democrats and Republicans wanted. It changes the fundamental banking regulatory regime to accommodate this new type of electronic money, these new digital dollars. It is about dollar competitiveness, economic competitiveness, national security, and that's a huge win. And that obviously for us as the leading regulated stablecoin network in the world is critical. And it's led to, as I mentioned earlier, all of these companies coming into this space. So it has surpassed my expectations on that. And then there's other regulatory work that's happening, which by all measures appears on track to become passed into law, likely in the first quarter of next year. Again, very bipartisan, not just a Trump administration issue, a bipartisan issue, and will cement the United States potentially as the leading jurisdiction for digital asset markets. That's a very big deal. And then the regulators themselves have been, effectively making it clear to banks, to securities firms, to asset managers, to technology companies, you can use this technology, just do it with good risk management. And so that's allowing more and more major firms to get in, and that's driving activity as well. So all of that is good. And so I think we're in the best position we've ever been in, and not just in the United States, but all around the world, every major government is racing to put in place sound policy in this space because the technology upgrades that are happening here are happening so quickly.
Jeremy, the old trope is stablecoin is anything other than stable. Have you alleviated those concerns?
I mean, Circle from inception has designed what we do as a regulated product that by law is required to have redeemability, have narrowly defined reserves under strict supervision by payments and banking regulators. And we're regulated, I think, by over 50 different regulators around the world or something close to that. I think, so the way we do things maybe isn't the way everyone else has done things. I mean, of the hundreds of stablecoin projects launched, I think a very small number were actually even regulated products. But now, with the Genius Act, with MiCA in Europe, with the UAE stablecoin laws, Hong Kong, Singapore, Japan, all these critical markets, all having stablecoin laws, they're very strict about the high quality liquid assets that back these digital currencies, the redemption rights, the supervisory rights, all of the prudential supervision that's needed to make this a critical part of our financial market infrastructure, which it's becoming. And so while there may be players who remain offshore and don't really want to come into a regulated regime, I think the market will decide with its votes, so to speak, what infrastructure they trust, what's transparent, and what actually has exceptional liquidity. I mean, I think we've minted and redeemed over $1 trillion of USDC. We've never once not redeemed $1 one for one.
Wow!
And so that's critical. And so that's the kind of infrastructure that people are going to need to depend on. And I think the regulations are catching up and saying, hey, you can't just go and launch a stable in name only stablecoin, as you I think correctly pointed out, which has historically really been a problem.
We do have some terrific questions coming through. I can also see on my iPad here that the questions are filling up. So if you do have a question for Jeremy, please submit it now using the QR code, and we'll do our best to.
Or we'll just answer questions from Anchor.
Oh, well, exactly.
It's fine by me.
Exactly. We can do that as well. But Jeremy, I wanted to bring it back to the Gulf as well, because Abu Dhabi and the UAE in particular have been quite early adopters of digital assets. Of course, Abu Dhabi also home to Binance, world's largest crypto exchange. And we saw a $2 billion investment by MGX into Binance that was actually paid for using stablecoin as well. So interesting. So what are you seeing that is attracting you to the UAE and to the Gulf broadly? And what are you seeing on the regulation side that's different here compared to the United States or Europe?
Well, I think the first is, as you noted, the UAE in certain markets, in Dubai, but also especially here in ADGM, have been first. They've moved faster. They've figured it out. They've taken a very pragmatic, practical approach. In fact, when we launched USDC in 2018, ADGM was the first regulator in the world to review it for safety and soundness and to approve it for use by market participants in the ADGM, which was way ahead of the curve. I think the digital asset rules, rules for building DAOs, stablecoin rules. Again, the jurisdiction here has moved, I think, as steady or more quickly than most other jurisdictions. I think what we see here is a few things. I think the first is, yes, pragmatic but strong regulation and supervision. We see access to one of the most dynamic regional markets in the world. This is becoming a huge concentrator of trade flows, not just in the Gulf, but more broadly regionally, spanning, Africa, South Asia, Southeast Asia, the whole region, and obviously globally as well in the commodity space. So a huge space. And when we look at this technology in particular, stable coins and blockchain networks are going to be really good at supporting businesses who have cross-border as part of what they do. And it's a very strong fit to cross-border. And I think this is already obviously a cross-border hub. It's going to be a bigger cross-border hub, as you can see just walking around. And so I think that makes it one of the most attractive markets in the world, and why we've been investing to really grow here as well.
Should we do it then, Dan? Should we get to the audience?
Let's do it.
They've once again delivered. I think very apt question, considering what you just said about the Middle East and about the UAE, is how is Circle navigating, and this is from Zishin, thank you. How is Circle navigating regulation in the Middle East and UAE? What challenges and opportunities do you see for stablecoin? Well, that's 3 questions, but we can allow that.
Yeah, so I think the first is making sure that a hub jurisdiction like the UAE is one where we are well regulated, and we've been working very, very hard on that and are excited about the progress that we're making, and hopefully we'll have more things to share about that this week. But
you want to share now? I think you've obviously got some news, Jeremy.
I don't. But
we won't tell, will we?
We're excited about what's happening here. I think secondly is, to the comment I made earlier, is the region as a whole. There are, again, across Middle East, into South Asia, into parts of Africa. When you think about the region as a whole, and this as a financial hub and a trade hub, stablecoins have already become so important. If you look at markets like Turkey, Egypt, some of the East African republics, Nigeria, Pakistan, and many other markets, stablecoins have become very significant. And so I think when you get regional hubs building rules, then these other markets follow suit. And so what we're now seeing, and this is both a challenge and an opportunity, is governments like Turkey and Pakistan and Nigeria and Kenya and South Africa and others, and obviously large players regionally here like Saudi, really looking at this, and some of them with draft legislation coming out. And so we're staying in touch with all those governments. We want to make sure that if they're going to have clear rules, that quality, well-regulated infrastructure can work in those markets. And so that's key, getting that in place, and I think we'll see that accelerating in 2026.
I really like this question from Steve's best friend, Ankur, as well, also coming through. So let's go to this one next. Central banks, governments appear unwilling to give up their ability to wield influence as they do through fiat. They want stable coins, but on their own terms. Your thoughts?
Yeah, I mean, this comes back to the question earlier about the role of the dollar as well, and I think we've certainly seen stablecoin growth in countries around the world where households and businesses are saying, "Hey, this is great. I have digital dollars. I can transact with people. I can transact internationally." And I kind of compare it to when people figured out they could download WhatsApp and then communicate with people no matter what country they lived in. Sort of the internet, right? And it makes sense. But at the same time, right, you need that local currency integration. And so I think our view has been, we want to build the best infrastructure possible for local governments and let's call it their champion financial firms, to build stablecoins on their own terms. So the ARC network, which is our blockchain network infrastructure, launched with, I think, nearly 10, or was announced with nearly 10 different local stablecoins from Latin America, Africa, parts of Asia. And we expect most governments to have rules and to work with their firms to have local currency stablecoins working, because on-chain money, programmable money that can run on these new economic operating systems is just as valuable if it's a Nigerian naira stablecoin as it is a dollar. It's the technology unlocks that. And then you can bring those together through FX markets that are built entirely on blockchain networks and get atomically swappable, real-time cleared and settled FX as well. And so those things start to come together, and we launched something recently in a test phase called Stable FX, which basically is a markets infrastructure for all these different stablecoins from all around the world for local government supervised and local currency stablecoins to have markets together that can clear against each other and against things like USDC as well.
Vasi is the next question up on the list. There is, will the next major crypto companies be energy companies, compute companies, or AI companies? Do you have a view on this one?
Well, it's actually a really good question. And, I think it's, when I look at companies domestically here like G42, which, kind of integrates a lot of different pieces, but also is partnering with the biggest AI platform companies, the biggest chip companies, the biggest data center builders, hyperscalers, but is also vertically integrating a lot of stuff. I don't know how I'd describe a company like that. Is that an energy, an AI, and a compute company? Maybe it's all three. But there's value chains there, and there's value chains that are integrated. And I think my view is that the value chain of AI infrastructure, the compute, the data centers, the inference infrastructure, and the clouds that sit there is going to converge with these new economic operating systems. They're hand in glove. In a world where economic activity is increasingly executed by work conducted by AI, you need these decentralized trust networks that are for economic coordination to make them work. And so I actually think you'll see more and more alignment in that space. And that's something that we think about when we think about how Arc Network is going to grow and be deployed around the world. I don't know. Well, I guess I'd say this. I think internet financial platform companies like Circle are going to be significant standalone internet platform companies, just like AI platform companies will be standalone in many cases, and energy companies will in many cases be standalone as well.
Yeah.
I love this next question as well. This one's for the traders out there. What do you do with the interest coupon collected on the T-bills that back USDC?
So a couple things. I think the first is just to understand the way that we work. So we run a stablecoin network. That network consists of all of our infrastructure all around the world to provide what I call the digital dollar dial tone in all the banking systems and markets around the world, all the regulatory infrastructure, all the infrastructure to make this work across 30 different blockchain networks and make that reliable and always work. And so we provide that to the public internet. And our stablecoin network is essentially a free public utility on the internet. Any developer, any person, anyone with an idea can basically access a dollar digital currency payment system at virtually no cost. And so that's a huge amount of value that we provide to the world, and it has unlocked a lot. Now, with that, we hold all these trillions of dollars of transactions run on that, and people build it into their products and services, and they get that for free. We hold the money stock behind it, and we hold it in things like T-bills, per the question. And Circle takes that as one of our biggest sources of our top line revenue. But what we also do is we work with the biggest distributors in the world to basically build distribution relationships where we take some of that income and we distribute it out and share it out to distributors that are marketing, distributing, doing product integration. So think Binance, Coinbase, many, many others. And so we're really focused on growth and incentives that build this into more and more products and services. And then they themselves may have programs for their users that are beneficial as well. But fundamentally, we keep that top line, but then we build distribution partners. And you can look at our public financials to sort of see exactly what that all looks like.
Jeremy, absolutely fascinating. Genuinely, I've learned an enormous amount today, and there's a lot I need to go home and do my homework on as well. But thank you very much indeed.
You're welcome.
It's been absolutely fascinating, and I think we've all learned something from Jeremy Allaire, who is the CEO of Circle. Thank you very much indeed.
Thank you.
For that.